Welcome to our second video in our introduction series. In this video, we will be introducing you to various terms and concepts which you need to be familiar with to advance your knowledge of management accounting. Our objectives for this video are firstly to remind ourselves why all this cost information is required in the first place. We will then understand the idea of a cost object. Once these two ideas are fully understood, we will then start looking into the various cost terms. As you can see, we have 18 terms that we need to familiarize ourselves with if we intend to be successful management accountants. Now that is a lot of cost terms, and there are probably even more, but your understanding will come with practice. Let us then remind ourselves why we need our cost information. Remember from our previous video that there are 3 pillars to management accounting. We need cost information so that we can cost a product or service and determine our company's profits. Cost information also helps us to make better decisions around issues such as discontinuations, outsourcing, special orders, and the like. Finally, cost information helps us to plan ahead as well as to identify deviations in past performance and take steps to rectify them. Now let us dive into the terminology by first understanding what a cost object is. This is a term that we will use quite regularly. A cost object is simply anything for which we want to measure the cost. It is a very broad term which may encompass products, services, departments, regions, or anything that you want to measure a cost for. Now let us look at our different cost classifications. Our first cost classification is direct and indirect costs. Direct costs are those costs that can be specifically and exclusively measured and identified with a cost object. The types of direct cost we get are direct materials and direct labor. If we are making a product, we can generally observe the direct costs going into the product. If we look at furniture manufacturing as an example, we can observe the amount of wood being used to make the item as our direct materials. Likewise, we can keep time records of how long our labor takes to physically work on the item as our direct labor. Because we can easily quantify how much direct cost goes into the product, we can trace that cost to the product or the cost object directly. Indirect costs, which are also called overheads, on the other hand, cannot be directly traced to the product. They could include items such as supervision, repairs and maintenance, or lighting and heating. These costs are required for the cost object to be completed, but we cannot accurately say how much of the cost object used. So because we cannot directly trace the cost to the cost object, we need to estimate the resources used by the cost object through a process known as cost allocation. We will have a separate series on this topic of cost allocation. Now, while we are dealing with direct and indirect costs, let us also consider manufacturing and non-manufacturing costs. These terms are more applicable to the manufacturing environment. Our manufacturing costs are those costs that are involved in the manufacturing process. They are necessary for the production of a product. These costs include our direct materials, our direct labor, and any manufacturing-related overhead. Now, there are 2 further classifications we need to be aware of here. Our first is prime costs. These are all our direct manufacturing costs. Our second is conversion costs. These are the costs of converting our direct materials into our finished product and comprise the direct labor and the manufacturing overheads. On the other hand, we have our non-manufacturing costs. These are costs that are not involved in the manufacturing process, but are necessary to support the general business function. Examples would be administrative costs, such as accountants keeping records, and marketing costs, such as advertising to sell the product. Next, we have product and period costs. Product costs are those costs that are associated with the production or acquisition of products for resale. So, from our previous slide, all manufacturing costs would be classified as product costs. These costs are included in the valuation of inventory and are recorded as an asset, being inventory, until that product is sold. Once that product is sold, its value is expensed through cost of sales. You should be familiar with this idea from the matching principle in financial accounting. Period costs, on the other hand, are those costs that are not associated with the production or acquisition of products for resale. From our previous slide, all non-manufacturing costs, remember that these were our admin and marketing costs, would be considered period costs. These costs are not included in the inventory valuation and are recorded as an expense immediately when incurred. Now we move on to classifying costs by the manner in which they behave when activity levels or output increases. Here we need to consider variable, fixed, mixed, and step fixed costs. We will have a short discussion on them now and consider these in further detail in our series on cost estimation and cost behavior. The first category we have are our variable costs. These costs vary in direct proportion to the volume of activity. An example would be direct materials. As we produce more of a product, we need more direct materials. We then have fixed costs. These costs remain constant regardless of the activity level. We could think here of factory rental. If we have rented a factory, the rental cost remains the same no matter how many units we produce in that factory. Next are our step fixed costs. These costs are fixed within a given activity level, but increase or decrease by a set amount each time the critical level of output is reached. Considering our fixed cost example of factory rental, if our factory has a capacity of 10,000 units and we want to increase beyond that, we need to rent out a second factory. Each time we reach the critical point, being a multiple of 10,000 units, which is the capacity of our factories, we need to rent out an additional factory. This would represent the step increase as we move to the next level of output. Our final classification is mixed costs. These are costs which include both a fixed and variable component. An example might be telephone costs, where you pay a fixed line rental and then additional charges for each minute on the call. When we look at relevant and irrelevant costs, as well as the remainder of the cost terminology we will look at, we are mostly concerned with the decision-making aspect of managerial accounting. We will unpack these costs in a lot more detail when we get to our series on relevant costing and decision-making. For relevant and irrelevant costs, we are classifying the costs as whether or not they are relevant for a specific decision or course of action. Our relevant costs are future costs that change based on the decision we make. On the other hand, irrelevant costs are costs which are not affected by the decision. Let us think of time at university. You have signed up for a module and you are now allowed to attend the lectures. Your friends then invite you to a movie that clashes with your lectures. You could attend the lectures or you could go and watch a movie with your friends. Whether you attend the lecture or not, you still have to pay the fees for the module. It is therefore an irrelevant cost when you are deciding to attend the lecture or watch the movie. However, if you attend the lecture, you don't have to pay for the movie. If you go to the movie with your friends, you do have to pay for the movie. Therefore, the cost of the movie is a relevant cost as it changes depending on the decision you make. Another classification for our relevant and irrelevant costs are avoidable and unavoidable costs. Our avoidable costs are those that we can avoid incurring by changing our decision. Looking at our lecture or movie example, the cost of the movie is avoidable if we choose to go to the lecture. Alternatively, unavoidable costs are those that we cannot save by changing our decision. So in our example where you go to the lecture or the movie, we cannot avoid the cost of the module we signed up for. Therefore, it is an unavoidable cost. Sunk costs also relate to the decision-making process. In essence, a sunk cost is a cost that relates to a past event and will not change based on the current decision we are making. Let us think through an example. You purchased a car 5 weeks ago and are now deciding whether you should walk or drive to work. The purchase price of the car would be considered a sunk cost. It was incurred in the past, being 5 weeks ago, and it will not change if we decide to walk or if we decide to drive to work. Another term that relates to decision making is opportunity costs. An opportunity cost is the best benefit sacrificed or foregone as a result of choosing one course of action over another. Let us assume that you have just completed your schooling. You have an option to go out and work and earn a salary, or to study further at a university. If you choose to study further, you will be foregoing the salary that you could earn. Therefore, the salary is a benefit that you are giving up, and hence the opportunity cost. Related to opportunity costs is the idea of an opportunity saving. An opportunity saving is simply a cost or loss avoided as a result of choosing one course of action over another. So in our example, if you decide to go and work and earn the salary, you will be avoiding the cost of studying further. This avoided cost of studying further is therefore the opportunity saving. Opportunity costs are critical to our decision-making process, and it is therefore key that you understand them carefully. The final set of cost terms that we need to be familiar with are incremental and marginal costs. Now, these two cost terms are very similar, but do have a slight difference. Our incremental costs are the difference in cost between each alternative course of action being considered. Marginal costs, on the other hand, are the additional cost of one additional unit. So, what is the key difference between these two cost classifications? Marginal costs relates to the additional cost of only one extra unit. Incremental costs, on the other hand, relate to the additional cost of a group of additional units. So the difference is marginal costs relate to one unit, incremental costs relate to a group of units. Again, we will consider these cost terms in a lot more detail when we come to our series on relevant costing and decision making. That brings us to the end of our introductory series, which has covered what is management accounting and some basic cost terms and concepts which you need to be familiar with. We will expand on many of these concepts we have introduced in this series as we dive deeper into management accounting. Thank you for joining us, and see you in our next series.